Let's drill down a little bit beyond tech. Let's talk about other sectors that you both want to highlight and sort of the idea of us broadening out here. So, John, you see that the bank ETF, the KBWB, catching a political tailwind. Tell us about this. Is this a deregulation?
Absolutely. So we just think now with the new administration, I worked at a bank for 18 years and, basically treated like a regulated utility. You had to ask the government if you wanted to buy back your shares, increase your dividend. I do think that deregulation is a big theme. So with the idea now that there'll be more IPOs, more M&A activity, the funny thing about the banks is that they were actually, from an earnings standpoint, fundamentally getting very attractive prior to the Trump administration being effective. So over the last 1 year, it's KBWB is beating the S&P 500 by like 10-12%. So it's still pretty cheap in an area of the market that's very idiosyncratic. So we like it quite a bit. I see sometimes advisors use XLF, which has a lot of insurance exposure. A company like Berkshire Hathaway is closer to the top. But we just think like the large cap money centers like Goldman, JP Morgan, Bank of America, Morgan Stanley, which make up most of the KBWB, we think that's really the area you want to hone in on with this new administration and the headwind and the tailwind, sorry.
Very interesting. So then, of course, we have to talk about the whole spectrum. So let's go the other way. Instead of these large cap money center banks, Todd, you're looking at small caps. What's attractive there?
We are. So if we have a focus on the U.S. and making America even stronger, then small cap companies stand to benefit from that because they have less multinational exposure. And so smaller companies are in focus for us at VettaFi, but we think an active or a smarter index-based approach is a good way of doing that. So T. Rowe Price has an actively managed small and mid cap ETF, TMSL. Neuberger Berman has a small and mid-cap ETF, NBSM. We're showing that one on the screen. And then Victory Shares has SFlow. So the Neuberger Berman one is actively managed. Great way to tap into the expertise of a money manager who's sorting through the universe looking for attractive valuations and strong fundamentals. Whereas that SFlow product from Victory Shares takes a focus on companies with high quality, strong free cash flow generation, but it has a growth filter to it. So companies have to have been very profitable enough to make it into that screen, and we think SFlow is going to garner more attention in the year ahead.
SFlow, okay. Now, John, fixed income always in play when talking about diversification, but you see it as being a little tricky here. Does that have to do with interest rate policy?
Yeah, I mean, we've had a pretty, big range in the 10-year. I mean, if you just take a long step back during COVID, a 10-year reached, 0.6. It got as much as, 4.8 in December. So we think that, the bonds market has been pretty tough the last few years with a rising rate environment. I think you have to be much more tactical. T-bills at 4.5% doesn't give you much room when you factor in the high inflation that we live in. Plus then the, how bonds are kind of taxed for retail advisors. Credit spreads are very, very tight. We do like the mortgage-backed security space. So there's a ticker DMBS from DoubleLine, which gives you exposure to mortgage-backed securities. Spreads right now are like 130 bips. So it's in like the 80th percentile. And just to contrast that with USIG, which is 88 bips in the 7th percentile. So we think there's a lot more value in the mortgage-backed, space, but that's very, very myopic. It's very idiosyncratic. I think the general idea that we have for investors is that there's a lot of uncertainty with rates. I think the bond market is going to price extra term premium on the back end. So with all the political backdrop, it just feels like bonds is an area that you'd want to be underweight. And if you have to have exposure to it, certainly would rather be more active than passive.
All right, we covered a lot of ground here, gentlemen. That is all for now. My thanks to John and Todd. Tune in again next Monday for another ETF Edge.